So we invested into a company called DSFC long time back, and the company was sitting on cash and investable assets of liquid assets almost worth 1400 crores. At that time, the valuation in the markets were something like 2000 crores. And at the same time, the company had earning capacity of almost like 400 crores. So you could easily figure it out that within a year or 2 years, it's going to become a cash bargain. Cash bargain is when you can essentially sell off a company, break it off, sell it off, and recover all the cash. So as an owner, it becomes very easy for me to buy this company for 2,000 crore rupees and wait for another year, let it generate some money, and then I'll have a recurring cash flow of 500 crore rupees. So these kind of opportunities can easily be identified by using some statistical analysis and models. I hope you are using Progress or Capital Line? Capital IQ. So what is I think a bigger component of security analysis is what we call as qualitative analysis, or what we call as unknown. So in qualitative analysis, you need to go beyond the numbers, meet the management, do a lot of scuttlebutt, talk to the managers, employees, ex-employees, partners, customers, and then you need to figure out whether it is worth investing or not investing. Now, security analysis, the quantitative aspect was Grahamian, but qualitative aspect is more like a Munger. So, Charlie Munger. So, there's a famous story about these two, that when Graham would go into a shopping complex, he would buy anything which is available at 50% discount. But when Munger would go into a shopping complex, he would seek particular things which he is interested to buy. And he would wait for a long period of time till the point it comes down to his valuation. So, qualitative aspects give you nuances like what is the integrity of the manager, how much skin the management has got into the game, whether the company, the promoter, the jockey is a good one or not so good one. So most of the time, many of the time, we are incapable of understanding a business from outside because we are essentially outside minority investors, and at the same time, even the managers themselves do not have capability to understand how the economy or how things are going to change. For example, demonetization which happened last year was a supreme black swan event, and last year I spoke about an industry called small finance bank and microfinance industry as a case study, and many of the banks who were extremely aggressive in the market, who were growing at 200%, 300% types, slowly they started showing off losses, NPAs in the books. On the other hand, the managers who were conservative, back-footed, they were able to tide through those uncertain black swan kind of events. So it's very important that you figure out a manager who is a trustworthy, good manager, and you let it ride in good times and bad times. We can't figure it out sitting outside. We don't have capability to understand the businesses through and through. So you have to trust the managers. Now, another point which comes into this thing is expected value. So, how do we calculate margin of safety in this kind of business? It's very difficult. So essentially, you are soliciting information from the managers in the con calls and the interviews to try to judge how the company, what is the kind of runway a company has going forward. I mean, if you are knowledgeable, let's say Amazon, you are able to see that there's a massive shift from stores to e-commerce. and that has been appearing in the numbers on year-on-year basis. It's been growing like 30-40% on a year-on-year basis. And if you are able to project what is going to happen after 5 years or what is going to happen after 10 years, and then you bring it backwards to figure out whether it is an investable opportunity or not an investable opportunity. You got to view a company from a non-mathematical point of view, which means that sometimes only deep understanding about the businesses will give you an idea as to what's happening in the business. For example, if we do quantitative analysis using ProVis or databases, we get to see certain companies who have got huge amount of debt as in 31st of March. But there are industries like paddy, like cotton, like sugar. Now these industries, their season starts from October. So they would start accumulating crops for 5-6 months and their debt would spike during the March quarter. So it's not necessary that like a horse you have to only view the 31st March balance sheet as a standalone thing. But you need to maybe construct your own balance sheet in between the years somewhere according to the nature of the business to figure out how the business is going to behave. And a lot of people miss these opportunities because they are viewing it from a single vantage point. I think beyond this, the more bigger issue is of the allocation. The security analysis and gathering of information, anybody, you can deploy anybody. But as a fund manager, as an MBA, the prime job you have is to rank the opportunities which are there in your investable set. If you are not able to rank the opportunities, there is no point in doing security analysis. That is not even 5%, not even 10% of the entire deal. You should be able to see what is the kind of rewards which are available and what is the kind of risks which are there in the price or in the balance sheet. There is a book called Fortune Formula. I encourage you to read this book because it will give you understanding about this part. But at the same time, if you start reading the letters of multiple managers, there are umpteen number of letters and interviews of US-based managers from where I have primarily learned because they were, as Professor also said, they were ahead in the game by 30-40 years. So if you start reading the letters are available free of cost online. They have discussed their own case studies whereby they have defined what they have done under different circumstances. So read this book, read the letters. You need to develop this allocation policy. And now the question comes at this stage whether you should be diversified or you should be concentrated. So a very nice, somebody spoke about this very nicely. Somebody said that if you are, for example, holding 24 stocks in your portfolio and you're rotating this over a period of 2 years, which means that every month you need to find one single stock, which is illogical and inopportune. It would not be possible at all to figure out one stock. You do not find stocks, but you wait for the times when the market crashes and prices come down to your level at which you want to acquire. So it is humanly impossible for a fund to figure out 1 or 2 stocks every month. We have got very, very slow rate. We are very passive in the market. If we get one in 2, 3, 4 years, we'll be happy about it. So we are not looking at too much of churning of portfolio or too much of activity in the market. Again, the switching costs as you go ahead in building your portfolio and as the size of your portfolio increases, the switching cost of churning your portfolio will keep on increasing. For example, let's say you bought an opportunity which is a purely Grahamian opportunity which you bought, let's say, at 50 cents to $1. And as you read, you will understand what 50 cents to $1 is, which basically means that you're buying at 50% discount to the intrinsic value. So if you are buying an asset at 50 cents to $1 thinking that you'll be able to sell it at 80 cents or 90 cents to $1, and if you revolve this 2-3 times, at the end you will come to a stage where your portfolio will grow bigger and you will realize that it's impossible to deploy that kind of money. And usually people start finding compounding machines with a period of 7-8 years. People are more interested in figuring out compounding machines where they can invest the money for a longer duration and just sit and let the company perform well. Buffett gives a good example. He says that if you are able to figure out 20 good companies in your entire 70-80 years of career, that will be like that. He himself concedes that their own performance record is because of 10 or 12 good companies that they have selected. And Munger is very strict about this policy. He says anything more than 3 in a portfolio is like a zoo. He says you need to figure out companies where the idea is that you should not be selling it out, where it is safe to hold those companies. So lesser the switching costs, lesser the taxes which you will be paying, lesser the brokerages which you will be paying, and lesser the all sort of in-between expenses you will be reducing. And the most important part of allocation is when to hold cash and when not to hold the cash, which as you proceed you will understand. Our default policy is to hold a lot of cash, and our default policy is that the moment we get a good opportunity to invest, we would want to invest irrespective of the market level. So that is what we do. And I think your entire strategy will essentially come out of your own personal temperament. Essentially, you are not just making a portfolio, you are constructing a system, you are designing a system. So you've got to understand what kind of clients you need to accept, how much longer do you need to be in the market, what are the kind of companies you should select. Slowly and slowly as you progress ahead in your life, you will understand this systematic design about management. One of my mentors has this formula called KCP, in which he says that knowledge will build conviction, and conviction will only get you patience. So the more knowledge you have, the more conviction you'll be able to have, the more patience you will have. And finally comes the role of LTD, which means ability to take timely decisions. You will get small window of opportunity in the market, like what happened in 2016 in the demonetization period. Now, in that period, if you are not prepared, if you are not thorough with your work, you will miss that window of opportunity very fast. So the idea is you be prepared and let the market come down to your level. So if you study Buffett beyond his returns and risk, he will talk about a lot of personal virtues, and his master strokes are not that he invested 40% into MX or 35% into stamps or seed candies or whatever, but his master strokes were that he was able to move, he decided to operate out of Omaha, which is a small town. He decided to cut himself off from the noise of New York, Wall Street. He decided that he is going to present an annual report once in a year. So a lot of such things, the focus which he brought into his investment strategy, the kind of opportunities which he actually started selecting, especially after the influence of Charlie Munger. So all these things are very well written down into the letters of Buffett. I encourage you to read all the letters. There's a video on the YouTube called Gorilla Experiment. I don't know how many of you have seen that. Yeah. So it essentially talks about the focus, and if you are not focused on the things which you want to achieve, you will miss a lot of opportunities. So, as Munger says, it's not a difficult task if you spend frugally and you keep on saving something and you keep on investing in tax-deferred assets. You will essentially become richer and richer every year. So, thanks. This ends my presentation. Thank you. You can ask questions.